2025 Mortgage Market Outlook and Smart Ways to Use Your Home Equity. Hello, everyone. Duane Buziak here, your Mortgage Maestro. Welcome back. In today's episode, we're talking about where mortgage rates are heading as we close out 2025, how the housing market is shifting, and the smartest ways to use your home equity right now. By the end of this video, you'll understand what's really happening behind the numbers and how to position yourself for success heading into 2026. Let's begin with the big picture. The Federal Reserve has held rates steady through the last 2 quarters, waiting for inflation to show consistent improvement. We've seen progress. Consumer prices are easing, wage growth is steady, and energy costs have leveled off. But policymakers want more confirmation before cutting rates. That's why mortgage rates remain near their upper range, around the mid-6% level for many borrowers. The encouraging news? Volatility has cooled. We're no longer seeing those wild daily rate swings that made planning so stressful a year ago. Instead, the market feels balanced with more predictable movements. That's giving homeowners and buyers alike a chance to breathe and plan long-term again. Housing inventory is still tight in many states, especially across the Southeast. In markets like Virginia, Tennessee, Florida, and Georgia, demand continues to outpace supply. That's keeping home prices firm and, in many neighborhoods, still rising slowly. For existing homeowners, that means one thing: equity growth, and that equity opens up opportunities. At Coast to Coast Mortgage, we've seen a major increase in homeowners exploring ways to leverage that equity, either through a HELOC or a home equity loan. Both options can be powerful financial tools when used wisely, but they work in different ways. So, let's refresh what each option really means. A home equity line of credit, or HELOC, acts like a revolving credit line tied to your home's value. You can draw funds when you need them and pay interest only on the amount you use. It's flexible, perfect for phased projects, education costs, or supplementing cash flow. Most HELOCs come with variable rates, which means your payments can move as the market changes. A home equity loan, on the other hand, gives you one lump sum upfront at a fixed interest rate. You start repaying immediately with stable monthly payments. It's ideal when you know exactly how much you need, say, for a remodel, debt consolidation, or large purchase. The stability of a fixed rate brings peace of mind, especially in a shifting economy. So, which is right for you? Here's how to think about it. If you value flexibility and might need funds at different times, the HELOC is your friend. If you prefer predictability and want a locked-in payment schedule, the home equity loan wins. Both rely on the same foundation, the equity you've earned, but they serve different lifestyles and comfort levels. Ask yourself 4 key questions.